So, Jack, oil, $115 a barrel last time I checked. That is still way below the 2008 high of 147. But you know what? Negative $37 was a lot nicer at the pump. How high can this go before companies start pumping more oil?
It can go well higher. I mean, you need more supply or you need less demand. And so you say, well, we have tons of shale oil in the U.S. Why don't we just drill more? Remember, the shale drillers took a beating during the pandemic. The oil price came back. Their stocks have come back. Their shareholders have said, hold the line on production. We don't want you to overproduce and set off another oil crash. So I reached out to Rick Muncrief. He's the CEO of Devon Energy. And I said, do you have any wiggle room now that we've had the events in Ukraine? He says, no wiggle room. He's looking at flat production this year. He says the plan is the same. The problem is, he says, if he starts going after new barrels now, he won't have them for 9 months, maybe 12 months. He'll have to pay 15 to 20% more for rigs than he did a year ago because of inflation. And then if you look at the futures curve on oil, the futures curve is telling him that the price is going to fall over the next year to $85. Now, that may or may not happen, but for the publicly traded oil companies that have to answer to shareholders, he says, you need a change in the shape of the curve for them to get excited about drilling. You might see private drillers drill more, but maybe not the public ones. And that leaves, I spoke with Hough. She's the head of commodity strategy at RBC. You've got basically 4 countries out there that have quick, easy access to new barrels: Saudi Arabia, Kuwait, Iraq, and the UAE. And Saudi Arabia is by far the most important. They don't seem too eager to increase output. That leaves the possibility of falling demand. What about demand destruction if prices get so high? Halima says the problem is during the 2008 oil spike, you didn't see that kind of demand destruction until oil was trading in the 140s.
How would sanctions play into this if we were to somehow reduce the amount of oil coming out of Russia?
Stifel, the investment bank, says if you took all Russian oil off the market, you'd see $200 barrel of crude. B of A says that would give you a 2 percentage point hit to U.S. economic growth. That would cause a recession, probably a bear market for stocks.